25 seconds away from the opening bell in New York City. Good morning to you all. We're shaping up as follows on the S&P. All-time highs on the S&P 500 at the close on Friday. We could add a little bit of weight to it. Up 3 on the S&P. We advance almost 1/10%. We are down on the Nasdaq, down 59 and off by 0.4%. There's the opening bell. Switch up the board and get into the bond market. We've talked about that range. That intraday range on Friday was just huge. Right now, 156.83, a really narrow trading range at about 157 on 10. So look out the FX market, euro dollar a snooze compared to what's happening elsewhere. 121.74 on euro dollar. We advance 1/10%. Cable through 141. It is very much a political story, supporting or at least taking away the support for the push forward of a Scottish referendum. Sterling with a little bit of a relief rally. The Aussie getting a nice bounce too off the back of what? A surge in the commodity market. Iron ore, copper, crude. Pick your commodity. It's got some green on it. Up 0.8% on WTI to 65.40. That's the cross-asset story with the movers at the market desk. Here's Abby.
John, well, we do have an all-time high, as you were mentioning, for the S&P 500. Not helping right now, though, is the FANG trade. You were just mentioning that Facebook was cut at Citi to a neutral. That's true, too, for Alphabet. On the analyst concern that there could be some reason for caution around ads. So both Facebook and Alphabet are down on that Citi downgrade to a neutral from a buy. Amazon, of course, big news this morning. They are offering an 8-part U.S. bond offering, the first in a year, to refinance debt and buy back stock. Those shares are down modestly, and then Netflix down as well. So big tech mega caps are lower. However, where we have strength, where we always have strength recently, metals and miners. This, of course, as we have copper close to $11,000 in London trading. Aluminum is up more than 1% with copper. Iron ore and steel both up more than 5%. So this commodity surge, it absolutely continues, helping out the inflation debate. Is this too many dollars chasing too few assets, or is there a lot of demand behind these huge gains, John?
Abby, thank you. Mentioning that Amazon offering 8-part multi-tranche, 2s all the way out to 40s. And just to give you an idea of the price, the reporting from Molly Smith of the team here at Bloomberg, 115 basis points over Treasuries for the 40-year piece of that debt offering. That sale kicking off right now. Let's get you the broader story for commodities. It's shaping up as follows. We're moving higher. Here's Kaylee Lyons for more. Hey, Kaylee.
Well, John, as commodities move higher, so too does the materials sector. We have really seen the Bloomberg Commodity Index, as it's rallied to its highest since 2015, take the materials sector along with it. And on Friday, it closed at a record high. Of course, the boom in prices we are seeing in some of the industrial metals in particular really aiding the mining and steelmaking stocks within that index. So where we sit on a quarter-to-date basis is materials is your big outperformer. It's up 11.5% over the period, outpacing the likes of other cyclical and value plays like energy and financials, and of course handily outpacing the broader market, which is up just 6.5%. And actually on Friday, the materials index closed at its highest relative to the benchmark, going all the way back to 2018. Now, as far as what the earnings story looks like for the materials sector, John, our Bloomberg intelligence team here in-house says that they should actually outpace the profit growth of the broader market through 2021. But they said guidance is really going to be important going forward, because as we move into mid-cycle, they could actually start to lag behind. So that is something to keep in mind as we see a divergence in the premium you have to pay for material stocks relative to the broader market. They are, of course, cheaper, a forward PE multiple of just around 20, John.
Kelly, thank you. Let's bring in a team. Academy's Peter Cheer and Steve Fall's Barry Bannister. Barry, let's not bury the lead. You're looking for a pullback here. Why?
Well, when you think about it, the taper, when it comes, and it's coming, is possibly going to cause higher real and nominal yields, and that will affect the market valuation. You also might see more than just mild and transitory inflation. The second half earnings are going to be discounted by mid-year. And the second half earnings are going to decelerate, obviously, from the very easy comparisons. And then I actually think there might be a little COVID bump in the summer. People tend to go inside, particularly in the southern states. And anyone who's vaccine hesitant is probably going to be convinced after that bump to get the shot. So you look at it, it's going to be a pullback, I think, of about 10%, but probably not more with the Fed doing all this QE, which is supporting the market.
Year-end price target 3,800 over at Stifel. Barry, one of the bearish out there. It didn't start that way, of course, because when these price targets came out, the S&P 500 was not where it is right now. We've seen huge moves, Peter Cheer, over the last 6 months. And Barry pointing out in his research, we've front-loaded some huge returns from November into May. Pete, when I spoke to Rick Reeder of BlackRock on this program last Friday, he was talking about running a bigger cash position, somewhere in the mid-teens across some of the portfolios, going into what could be a choppier summer. Does that resonate with you, Pete?
Yes, I do agree that we're going to see higher yields, steeper yield curves, and that's going to put pressure on some segments of the market. I'm really thinking, we probably talked about this before, this is going to be a stock pickers type market where you need to identify the right sectors who are going to benefit from where the economy is going to be 6 months from now, a year from now. And I think we also have to really think closely about where are the tax hikes going to come? Who's going to be impacted? What sectors should you avoid? So right now, I agree that we could see a 5 to 10% pullback, probably led by big tech. I think you're going to see other sectors like the commodity sectors continue to do very well as people get this real sense that this is a global reopening, global inflation trade, and there's a lot of potential growth, especially with long-term fiscal stimulus kicking in the U.S.
Pete, you're quite bullish inflation. Why? What's different about the circumstances now that changed the economic debate for you?
I think there's a couple things. One is I think we are starting to see wage inflation. When we look at Friday's economic data, you look at a lot of other data, the total jobs weren't attractive, but the number of job openings are high. And these are a lot of low-skilled job openings. So it's not a mismatch between skills and what employers are looking for. It's about not willing to work at a certain price. And I think that salary is going to come up because companies are going to realize they're missing an opportunity cost. And then I really do believe the shift towards sustainability is going to be inflationary. Companies are heavily incentivized to switch how they produce things. They're going to switch their products to be more sustainable, and they're going to be able to pass on that increased cost to consumers for the most part. And the other part will be able to be absorbed because their stocks will trade at a higher PE because of this ESG investing. So I think those are two things that are very, very different than we've seen any time over the last 10 years. And that's going to drive inflation much higher for longer.
Arguably, that's what we've seen in the copper price over the last several months too. Barry, I'd love your thoughts on a couple of pieces of that argument. One being the labour supply story. The shortages we have across this economy right now, some of, not all of them, can be addressed with higher prices. Do you think the labour market is one of those issues that will be addressed with higher prices, higher wages?
Clearly, I don't see a wage price spiral, but I think that there are some areas where there are skills mismatch. Also, you have school closures, which have been extensive and unnecessary in many ways, that have kept some parents at home. And then lastly, you do have some incentives not to work, but that's spotty. So all in all, I think it's going to require a higher price to clear the labor market, and that might get passed through, or it might compress margins, making that 32 times multiple on normalized operating earnings, 10-year average inflation-adjusted real operating earnings, more unsustainable. There's a lot of cognitive dissonance in the market. A high PE is going to require a long-term view, but the policies that support the high PE aren't viable long-term. So we have some problems with the market valuation and the inflation outlook. And
one of those policies that supports the higher PE, Barry, and you're pushing out against right now is yield repression, I get my words out. Barry, what is it about policy that you're anticipating? How do you think it will evolve in the summer that's going to lead to yields going the other way?
QE is increasingly counterproductive, not just in the pricing at the short end, but also for bank lending and creation of reserves. We want lending. We don't want the Fed creating reserves. So the Fed is trapped by its own easy policies due to the political climate in Washington. You know, we have a somewhat radical Keynesian MMT-funded populism right now, and the Fed is trapped in that. It can't afford to give up its independence, but can't afford to fight it too hard. So they're really between a rock and a hard place. So I would think that you would have to have some phase back of the Fed's QE before the market would adjust lower.
Really interested in that word radical. That's a political assessment of what's happening in DC right now. But Peter, looking at the market, I don't see anything radical about the bond market, 157 on 10s. And the number one question we asked last week going into that payrolls report, you take out Friday, the only question that I heard anyone ask in the bond market was, data's great, why aren't yields higher? Pete, what was your reaction?
I think right now everyone's focused on when the Fed will hike. And I think they're not going to hike anytime soon. I think what we have to start talking about is the terminal rate. How high will yields have to go to slow down inflation once they let it out? That's a conversation that's going to take place over the coming weeks or months. And also, while there's talk about them tapering, I think there's also a risk that they do an operation twist. They do something to suppress that long end of the yield curve. So we're in a very micromanaged yield environment where the Fed is looking very closely at it. So I think people got very short, they got caught. Now we have to be cautious that the Fed doesn't fight this yield or move to higher yields. But I do think we get it. I'm expecting the 10-year to hit 2% this quarter.
Just south of 160 right now. Pete, stick with us. I want to lean on some of the expertise of the generals over at Academy and talk about this Colonial Pipeline shutdown. Barry Bannister, thank you, sir. Barry Bannister there at Stifel, catching up on this market. All-time highs on the equity market. Barry looking for a 5 to 10% pullback through the summer. For more at the market desk, here's Abby.
John, well, there's a strong reflationary tone this morning. Two of the best sectors, energy and materials. Starting out with materials, we've already looked at copper and iron and the metals and mining stocks on the industrial side. Now let's look at the gold mining stocks, because gold is having a stealth rally up for a fourth day in a row, the longest winning streak in 3 months at its highest level since early February. This as the dollar is down, so gold is higher. If above the 200-day moving average, flirting with that level, the rally may just continue. Now turning to that pipeline story, we do have the shares of other pipeline companies, publicly traded pipeline companies, Kinder Morgan and Williams trading higher, along with some of the E&P companies, Apache and Devon, both up well more than 3.5%. This, of course, on that story that broke over the weekend that Colonial Pipeline was hacked and that the nation's largest pipeline is now down for a third day. So a nice rally there for the energy sector, and that is the top sector on the morning, John.
One of the most talked about stories over the weekend, too. Abby, thank you. Coming up, one of the largest pipelines in the United States shutting down. We'll get the political reaction and the market response as well. Equities down 6 points on the S&P. We decline a little more than 0.1%. We pull back from all-time highs this Monday morning. Good morning. This is Bloomberg.
It's a top priority for the administration. Unfortunately, these sorts of attacks are becoming more frequent. They're here to stay, and we have to work in partnership with business to secure networks to defend ourselves against these attacks.
The White House pulling together a task force addressing the pipeline breach. Commodity prices surging amid supply constraints, with gasoline prices touching fresh 3-year highs. For more, I want to bring in Emily Wilkins in D.C. and Kelly Lyons as well. Emily, let's just start right here. The debate down in Washington regarding this, what does it sound like?
So at this point, lawmakers are still starting to weigh in on this since it is developing over the weekend. But as you noted, the White House jumped on this pretty quickly with a task force that they want to not only investigate how the cybersecurity breach happened, but also make sure that the markets are not hurt by the stoppage of oil from this pipeline. Also looking to Congress to see what they might need to do. We've already heard from Congresswoman Yvette Clarke. She is the chair of the House Subcommittee on Cybersecurity. She noted that President Biden's infrastructure plan does not include anything specific on cybersecurity for infrastructure, but she said she wants to make sure that as the bill gets written by Congress, that there are cybersecurity items in it.
It is going to make Wednesday's meeting between the president and the Democratic and Republican leaders just a little bit more interesting. Emily Wilkins down in D.C. Emily, thank you. Kelly Lyons looking at the price action, the moves. Pretty obvious, Kaylee.
Yeah, they are, John. I would say they were more obvious earlier on. Actually, now gasoline futures were up 4% at one point. Right now, they're only higher by about 0.7%. And even WTI crude has now actually flipped down on the day. We're trading below $65 a barrel as the market really tries to digest how much this pipeline closure is going to matter at the end of the day. A lot of that's going to depend on how long it lasts. But this isn't even the most exciting price action in the commodity complex today, John. Really, that was in the industrial metals. Overnight in Singapore, iron ore hitting a record high and copper hitting a record high on the London Metal Exchange as well. When you put together the rally we have seen in the industrial metals over the last year, the Bloomberg Industrial Metals Index is up the better part of 70%. Now, part of this is the broader narrative about the economic recovery, the demand that will come with it, and of course, dovish central banks. Goldman Sachs calling that a Goldilocks scenario. But there are more idiosyncratic factors here as well, one of them being China and stricter potential environmental regulations. That's giving a lift to both iron and copper. And of course, copper has the whole green transition narrative behind it as well. So when you put together what we're seeing in the industrial metals, what we're seeing in oil, what we're seeing even in the ags, the Bloomberg Commodity Index is at its highest since 2015. And the rally has brought the index into incredibly overbought levels. The 14-day RSI now at 84. Of course, 70 is what indicates the technically overbought threshold So that could indicate some downside is to come, John, especially when you look at the fact that the 14-day RSI on the S&P 500 is only at 65, and it is very rare that these two diverge. So the question is when and how may they come back together, John?
Kelly Lyons, thank you. A couple of pieces here in the commodity market. Let's bring in Peter Cheer for one of them. This was Pete's quote in his research this morning off the back of all of this. We are vulnerable to cyber, and cyber can transfer digital risks into real-world consequences. Peter, was excited to have you with us this morning because I know the team over at Academy is made up by former generals, people with military experience. Can you walk me through the framework that you and the team have established to really think about these issues?
And a couple of our generals really do have a lot of experience directly with cyber. They set up U.S. Army Cyber. And I think there's a couple things that we wind up talking about a lot. One is that a lot of this comes down to the weakest link. Within each company, it's always the weakest link who left their password unprotected. It also comes down to within an industry, right? Where is that weakest link? How can that be exploited? And we talk a lot about, cyber being a domain of war. And if you think about other domains of war, whether it's air, sea, land, space, there's definitions, there's rules of engagement. Everyone knows what they're allowed to do, what they're not allowed to do. That gets very gray area in cyber. And as you see in this attack, it's likely a criminal enterprise, but in conjunction with a national enterprise. So I think we're going to have to do a lot of thinking on our side, how to get industry groups to work with government to really have a solid defense against this.
Is this an event that I should prepare my portfolio in anticipation of, or an event that I should be planning a game plan, a plan of action in response to?
No, I think it's something we've got to be very cautious of. And when you're looking at companies and industries, really dissect what is their cyber exposure. I think we also have to think a lot about municipalities, because when we talk about the, say, weakest link type concept, right? You have thousands of municipalities running various water, all these other things very individually. And do they have the critical mass, the infrastructure spending to make sure that they are hardened against cyber attack? And one of our worries about work from home has been that effectively work from home spreads out these attack surface, right? So it makes it easier for criminals to gain entrance into this. And, I hate to burst the bubble on crypto or anything like that, but I think people have to take a long, hard look at this, right? This attack was largely due to ransomware. It's a ransomware demand, which will be paid for via crypto. If Bitcoin wasn't $1 trillion thing, would these attacks happen with the same frequency? So I think there's going to be a lot of discussion in DC about what crypto means now, both in terms of ransomware and our ability to reflect power through the US dollar and sanctions.
So, Pete, let's be clear about this. Because the settlement mechanism in this case may well be crypto, in other cases it has been, you think that puts it under a tougher regulatory spotlight?
Yes, I think the governments are really going to have to say what is going on, not related to this, but the arms deal, right, where we caught, trapped the arms, I believe, just outside of Iran. Again, that's probably paid for in crypto. So these have real world geopolitical consequences, and especially as we're seeing that, as we mentioned earlier in the show, that transformation of digital risk into physical risk, right? This is only oil. You hate to say only oil, but if these attacks become more dangerous and hit us harder, it will lead to actual physical casualties. And we're going to have to figure out as a country how to deter this and what we want to do in response, because I think our deterrence has probably been a little bit slap on the wrist. And we have to figure out, is that the right way to stop these from going on? Because they are only getting worse, and it seems like that's the path unless we stop it.
And Pete, these are high-level, sophisticated conversations that you're having with former military personnel, generals who have served in the military here in America. You have to forgive me because I have to bring it back to a juvenile question and reduce it down to one single theme in markets, which is, what do I want to own? What don't I want to own? What are the answers to those two questions?
I think it's very difficult to tell, right? I think you want to really check with the companies that you're involved with, how secure they are, what their cyber plan is. I think, just like ESG has become more and more a component, people are going to really want to know, what are the cyber risks? What happens if you get hacked? And so far, when we've had these hacks, most of the companies that have been hacked, their stocks actually respond reasonably well after initial fade. So far, there hasn't been a punishing factor. I think that starts getting a little bit worse. It's going to be part of the scrutiny. Unfortunately, I think it's just one of these risks that currently we have to live with.
Pete, thoughtful, always thoughtful. Peter Cheer of Academy. Pete, thank you, sir. Send my best to the team. Let's get you some sector price action this morning. Here's Abby.
John, we opened at all-time highs and now we've retreated ever so slightly, and that has to do with the sector composition. Reflation in charge, mega caps lower. If we go into the Bloomberg terminal and use the IMAP, we will see most sectors are lower, but the three sectors that are down, those are your mega cap sectors. Discretionary, that's on Amazon, communication services, Facebook, Twitter, Alphabet, and then tech, Apple and Microsoft. So we see weakness there. On the other hand, materials and energy are up. And if we flip up the board, we can see this very simply that, again, energy and materials, the top sectors, tech, the worst sectors. And because tech and communication services, because the weighting is so much the S&P 500, that's why we have the index down ever so slightly right now, John.
Abby, thank you. Coming up, a week full of data. We'll bring you the trading diary from New York City. This is Bloomberg.